For Q&A. We'll take some questions from the audience sitting here before we move and take some from the participants who joined virtually. The mic is there. Just a gentle reminder, please identify your name and media house before you go into the question.
Hi sir, this is Siddhi from Reuters. Hi. Congratulations on the IPO. I had a few questions. My first question was, this is the timing basically. There's a lot of market uncertainty and volatility that's going around. I just want to get a sense on why you chose this particular period to launch the IPO. And secondly, I wanted to ask what was the push for doing the listing right now? Was it just the fact that an RBI particular regulation was mandating you to do it, or how much was the company actually ready to list? If you could throw light on these two questions first.
Can you hear me?
Yeah.
Can you hear me?
Yeah.
Okay, so we are a 17-year-old company, built competencies and capabilities, run through cycles. We have a large franchise. For a lender, it's very important to build a franchise that is truly something that can sustain through cycles and build capabilities. So in that sense, in our company's journey, this is the right time to do the IPO. We also are up there in NBFC, which means that we have a regulatory mandate to list.
Okay, but what about the market vulnerability at this point? Is there any concern on that? Because that will obviously affect your listing as well, right?
Just to add to what Ramesh has said, so the timing of this IPO, two things is narrated very well. 17 years, it was part of a process where we were going ahead. And yes, the RBI circular, which stated that we need to complete this by September 25, and that is the principal reason. Market conditions will always have some positives and some negatives, but we were very clear as a board, and just adding to what Ramesh said, that as soon as conditions and approvals are in place, we will be doing the IPO, and that is what is happening.
And maybe if I can just add one more point, because you did ask about why now. As in the public domain, the DRHP approval came in, we were on extensive roadshow. I think it's basis the investor feedback that we have decided. I think the list will be published on Tuesday. The anchors. I think across both foreign and domestic investors, we do believe people have appreciated what Ramesh and team has built out, and we see a strong response.
So one last question.
Excuse me, Cindy, I'll request you to
Just one.
stick to one question per media house so we can give everyone a chance to.
Last one, just a technical one. How much stake will HDFC? How much stake will be brought down by HDFC Bank? Just that one.
So HDFC Bank will move to around 75% once the IPO goes through.
Yeah, this is Rajesh from Bloomberg. Our first question is, what are the challenges your firm is facing when most of the commercial banks are ramping up their operations and their cost of borrowing is much lower than yours? Second, there were news that Mitsubishi Financial Group is planning to acquire minority stake in your firm. Is that still that proposal still is on your table, or is there any information from your promoter on this? The third question is, your price.
Write down the question.
Yeah.
I thought you said one question per person.
Yeah, last question. Your price, your IPO, at least 30 to 40% discount to off-market transaction. What are the rationale behind valuing your company at $7.5 billion when off-market transactions are happening at $10 billion plus?
So your first question is on commercial banks also doing retail lending. So we serve a set of India that we call aspirational India, which is served and underbanked. We have presence in 1170 cities. Remember my presentation. This is a customer segment where what's worked best is deep engagement with the customer on a ongoing basis, along with customizing products. So when you look at this segment, it's not a homogeneous group of customers. Each about business lending as a category, each town in India has a different set of businesses that are accounted for the local economy, and so what drives the cash flows of the local economy. So when we look at enterprise lending as a business, we say what does the local market need, what are the requirements that these customers have, and how does this tie up to the cash flows of this local economy. And so that's the capability that we have built. We believe that an NBFC model is the best suited for this high touch model that we work. In terms of some investor interest, we are focused on the IPO. We filed our documents on October 30th, 2024. We've been talking to investors, and we believe that our focus is right now on the IPO. We'll make sure the IPO goes through. Okay, the third question was on IPO pricing.
See, the IPO pricing is something that has been determined, jointly by the entire syndicate. This is what we believe are the key strengths of this franchise, and seeing how peers are trading, where we believe we want to keep it attractive to investors. How a particular share trades in the unlisted market actually has no dimension of any engagement from the company, the management, or the BNLM. So we will not be able to comment vis-a-vis that. We have looked at it, as if this is an IPO, like in any other IPO. Evaluated what would be the right pricing for us to engage with investors, and I think that's the way we price this issue.
Sir, good afternoon. I am Mehul Dani from FinTech Business. Technology has been core to your strategy. What has been the average IT capex in last few years, and how well you serve the customer right from onboarding to collection? And will you increase the investment in the IT going forward?
Thank you, Mehul. Mehul, the way I would look at it is how core is IT to our piece, right? I think rather than put a number, times have moved where it was only capex. We would now look at the whole suite. Do we put in the right amount of investment, right, to deliver what we need to from a growth point of view? So an important focus for us across the last 17 years has been, as and when there has been a need, whether it is on cyber security or basic infrastructure or growth infrastructure in terms of building new capabilities as we serve our products and as we grow through our products, there has always been one simple fundamental that comes first. As there has been challenging times over the last decade or so, not even once has the company actually shied away and put IT infrastructure or any form of IT investment at the back burner. That's been at the core. And that's how I would like the investing community to look at it. In terms of specific numbers, it's part of this large document. I'm sure you'll get it very quickly. But the message I would want to leave is IT investment continues to be a core focus, and that's what we'll work on as we go through as well.
So, to add on to what Jay said, our businesses are very diverse. Think of a consumer loan, right, and think of a consumer durable loan. The maximum applications come around Dhanteras Day, right? When the application volume or the inquiry volume could be ranging from 25 to 50x of any other day, right? What we've done is to make sure that we have built the systems and processes to make sure that we don't decline applications on that day because we have too much of applications coming through. There could be other days when application volumes are relatively high. For example, most customers walk into and buy a consumer product between 4 and 7 p.m. on weekends. That's when we get the maximum traffic. In other products, for example, like a loan against property, there's a fair amount of engagement with the customer on an ongoing basis through the application process. And so what we've done is really build custom journeys. Our customer base has grown 2x in the last 3 years. Make sure that we made enough investments in technology so that that doesn't become a constraint. So adequate investments made ahead of time to make sure that we are maximizing the customer opportunity.
So I'm Sangeeta from Economic Times. So this is regarding the forms of business, the draft regulations from RBI. You have also mentioned them as a risk factor in your prospects. What I wanted to know is that if these guidelines are implemented as is basis, and it talks about the parent doing the core lending business, which are the businesses that will remain with HDB Financial and what would be the AUM of that business? And one more thing, you said that bulk of the organization's borrowing is directly from HDFC Bank or from banks? No.
I'll explain to you.
Okay, I just wanted to know how much is it as a percentage. Thank you.
So, on forms of business, RBI had brought a draft for discussion in the early October 2024, and then the draft of discussion basically invited comments and feedback from the industry participants. So the draft is now issued 8 months back. Can't really comment or speculate on what the final draft will be and what will be the impact on the company. As I said, as a company, we have an independent franchise. So when we think about whether it's our origination platforms, our tech platforms, independent of the bank. So in that sense, we're not dependent on HDFC Bank either for business or for managing our technology platforms. In terms of liability profile, about half of our liabilities come from the debt capital markets. About 35% of our borrowings come from banks, and we have currently a relationship with 20 plus banks, and HDFC Bank is one of our lenders. Because it's an RPT, the quantum of debt that we take from HDFC Bank and the interest that we pay gets disclosed in our annual reports on an annual basis. HDFC Bank is, by the way, not our largest lender; it's one of our large lenders.
No, we are not asking you to comment on the draft. What I'm saying is, what business will remain with HDB?
Yeah, so the forms of business circular, which is what you are alluding to, has two components which probably is main. One is that the forms of business circular is for the banks. So the banks cannot be in any business. That is, a particular bank, it's proposed, that cannot be in any business with some other subsidiary is doing. So HDB is the subsidiary, right? And HDB is not directly impacted by this circular. It is the bank which is impacted. So HDB has set up a certain business. There is some of the businesses are common to what the bank does. But HDB, there is nothing in the draft circular which states that HDB cannot continue to pursue the businesses that it does. It speaks of the ownership, if at all, of that. So the question of HDB not being able to pursue any form of business or any line of business is not even included in the circular, whatever be the final outcome that the circular takes.
Does that mean that the circular is so innocuous that the bank will store auto loans, bank will store personal loans and any other loan?
So the circular is not directed, again I'll repeat, the circular is not directed at the NBFC. The circular is for the bank. So because as a NBFC we are doing a certain line of business, we are free to continue to pursue that line of business. It is for the bank to take a call on whether they will, what shape and form it will
The
take.
bank being the majority shareholder, the promoter, the bank has the right to ask you to discontinue certain businesses, right? Bank will not take the personal loans or the auto loans.
So,
and
so
ask you to pursue that. That is not
So
what
it
the
has not
market circular is, right?
So therefore, it is not possible to comment on that hypothetical situation unless the final circular comes out.
No, but what businesses will remain? What are the common businesses? What is it which is not common? That's all. Just tell us which are the businesses which are
There is nothing which is uncommon.
So,
all the businesses are common.
as a company, we don't pursue any arbitrage between us and the bank. All the businesses that we do are businesses that banks are permitted to do. So there's no business that we do which banks cannot do or should not do that we do at this point.
Thank you, sir. We'll take a couple of questions from the virtual audience before we come back here. Just if you don't mind. The first question from the virtual audience is, how has HDB Financial Services demonstrated a significant growth in its customer base over the years, and how does this reflect its reach in India?
Right. So we set out to be a company that services India. We didn't set up the product company and that diversified later. Over the years, if you look at our track record, we have launched a new business almost every other year. The whole idea of launching a new business almost every other year was to build competencies around making sure that we are touching the customer as many times as possible in their life journey. So what is it that the customer will need through their life cycle and how do we service that requirement effectively? So as we have built scale, as we built products, we have had, we also built a platform by which we could originate customers using multiple channels. We are a truly omni-channel company, the way we originate business. So the customer has a choice in terms of how he or she comes to us and how the customer engages with us. We are comfortable whichever way the customer comes to us. And that's how we invested. We invested in distribution in 1100 cities. I said it's a heterogeneous market, which means that just because we're present in 5 or 10 or 15 or 100 cities, is no guarantee that the same product and the same service will be working in a few more cities. So we fine-tune our product, we fine-tune our delivery mechanism to the market that we present, and that's done at scale. And that's how we really built our customer franchise over the years.
Thank you, sir. We'll take the next question.
Good afternoon, Geetanjali Kedia from SP Tulsi and Investment Advisors. Can you share if enterprise lending, which is almost 40% of your AUM, is that on fixed rate of interest or floating rate of interest? And secondly, the NIM has been declining from 8.3% in FY23 to 7.9 and just 7.6% in 25. So could you comment on that as well?
So, in terms of our enterprise business, there are certain businesses which are longer tenures, like our loan against property. Those are on floating rate loans, but there are businesses such as gold loans and business loans, unsecured business loans that we give, which are typically shorter tenures, up to 3 years. So those are on fixed rate. So within the portfolio, the LAP business is on floating rate because those are typically contracted for about 8-9 years. Which anyone give answer?
So your second question was?
NIM is declining from 8.3% in 23 to 7.6%.
Yeah. So the NIM, I think the way you should look at it is our yields have grown, right? And on the cost of borrowing, we actually match how we do in terms of borrowing, which is we match our tenor. So our book is approximately 3.5 years. Again, that's part of the disclosures. Our liability side is approximately 3.5 years. And what's happened in the last 3 years is when you look at from 2021, the rate of interest actually went up very sharply, almost 250 bps. And hence there has been a temporary, I would say contraction in NIM is the way we would look at it.
So can you clarify how much of your AUM is on fixed and floating now, and how much of your borrowings are on fixed and floating now?
So my LAP book is on
The total AUM, not just
that's what I'm saying. My LAP book is on floating, which is approximately 23%. Right? Balance everything is on fixed. And on the floating side, in terms of borrowings, it's a very similar percentage. It obviously varies from month to month, right? Because you will have loans come in and out. So it varies, but it's a very similar percentage that we try and maintain.
So almost one-fourth is on floating. Is that a fair assumption?
That would be fair.
Thank you.
Thank you. The next question from Subra from Business Standard.
My question is on the circular again. I mean, did that have any bearing on the valuation? Were there investor concerns that going forward you may have to exit some businesses or?
Of course, as was widely reported, there was discussions around it, but the management was able to, very specifically address those. Where the discussion, the answer is yes. But as I said, we have a great set of anchor book that will get published on Tuesday, and wherein a lot of the investors, right, and this is just not mutual fund insurance companies, but top quartile FIs as well, which has got comfort around how to kind of model that as the company gets listed. So I would kind of look at it in that way. I think finally everything boils down to what is the interest levels, and that also kind of gives us this confidence to launch the IPO.
And a follow-up
Hi, my question again, this is specifically to bankers. I'm Hamsini, I come from Money Control. My question is specifically targeted at the bankers. I understand, as Ms. Dasgupta mentioned earlier, whatever is trading in the grey market is not a price that's come out of discovery by bankers, but it's often seen as a benchmark of what the market expectations are. So what really went through when you were doing the value discovery that there's a 66% discount to what was in the grey market, because there was a lot of trading as well on the other side in expectations of a good upside through IPO, etc.
Yeah, so I'll kind of repeat what Sonia said earlier as well. I think, this price has been determined basis extensive institutional roadshow. Whatever is happening on the unlisted side, I don't think it is with management explaining the business, understanding, what are the different nuances and all of that. So really, as management, as banks, we have no influence on what is happening in the unlisted side. IPO price discovery, as I said, is far more scientific and is also basis the inputs that we receive from high quality investors.
Even if I were to look at it from price to book at around 3.25 range, I would believe that for something coming out of the HDFC stable, it could have been a little better. It could have been a little higher than this. Would the valuations have been better had the issue been timed? I mean, I understand there's geopolitical tension, etc. Did all those factors also play?
So you believe that we left a lot on the table, right?
I think
that should only give more confidence to investors to, as always from the house of HDFC, they believe in having a relationship with their investors and making sure every stakeholder does well and makes money and has fabulous returns. If you believe it's being priced attractively, that's exactly what we wanted to spread the message. So that's been our endeavor to have a very attractively priced issue.
This is Gopika from Mint. Just a question to the bankers. There is a risk that the promoter shareholding in the company may fall to 20%. Now, post the RBI coming out with the final guidelines, it may not be immediate, but may be phased over a period of time. How did you sort of assuage the concerns of the investors on this front? Because the whole IPO is, betting on the parentage and the parentage support. So, could you clarify on that?
See, as has already been explained, I'll just reiterate it. This is a draft circular that was come out, and it's very difficult to build any scenarios around a draft which has not seen the light of day. Right? I mean, we've always had financially regulated entities have always seen a plethora of guidelines from many regulators, and they have dealt with it. Right now, the key focus is on building a franchise with all the right metrics: strong growth, strong governance, good returns, good asset quality. I think the focus has been on that. Very difficult to sit and speculate. You're right. There is this noise and potential that what if something like this comes, but it's absolutely impossible for any stakeholder, be it the bank or HDB, board or management, far less the BRLNs, to have any kind of analysis, because we just don't know what it is, right? And I'm sure, knowing their ethos of always taking care of all stakeholders, if and when the guidelines come, we will find a solution, which is a win-win for every stakeholder. We are very confident. Right now, the focus is on the business to make sure that they continue to grow from strength to strength and deliver stellar returns to their investors.
Can I have a question to the management?
Yeah.
On the asset quality side, again, it's been seen on the higher side, especially for a company which is coming from the HDFC group. How would you and also 70% of your book is secure, so how would you address these asset quality concerns, and how do you look at pairing it?
So, as said, we run a business that's independent of us getting leads from the bank. We are addressing a very distinct customer segment in the way we originate the customers and the way we service the customers. It's a customer set that we typically, in broad English calls underbanked and underserved. It's a market that we develop. It's not It's not a leading market that you are going in for market share. Our focus has been how do you create and build sustainable infrastructure and build sound risk management practices. So finally, I think what we are focusing on is a high quality customer experience, a sustainable business, and a reasonable risk-adjusted return. Right. So there will be some ups and downs as we go along in our journey. Something that we are we have experienced and learned over 17 years and delivered consistent returns. So that's something that we'll continue to focus on.
Hi sir, this is Manali from Dainik Shipping. What is the difference between book building issue and fixed price issue?
Sorry.
Repeat the question.
Fixed price issue is whether you just give one price and everyone is fixed price. Book building, we have a range, and investors can bid at any price point in the range of 700 to 740, for example, in this, and then we will decide the pricing basis where we get maximum demand and it clears the book. Sorry, I don't know. I can't see who asked that question. Oh, sorry. Okay. So this is not a fixed price. This is a book build.
The next question from
Joel Rebello, I work for the Economic Times. My question is to the company officials on DAS. I have been watching this company for the last 5 years or more. I just want to take Gopika's question a little bit forward. I have seen quarter over quarter or year over year asset quality fluctuates quite a lot. I've also seen margins fluctuating quite a lot. Your book has built quite rapidly. In the market as an investor today, there are other NBFCs which have a fast stable business or a fast stable environment that they work with. I understand that you're trying to do something which has not been done, or you're serving the underserved and all that. As an investor, why should I invest in HDB when I have other options?
Yeah, so I'll first try to address with confidence that asset quality has been, when I talked of governance, asset quality has been top of the board's mind as well. And if you look at post-COVID, 2022 till now, the asset quality for an NBFC, which our CEO has explained, serves a segment who's underserved because perhaps the risk is slightly different in that segment. And in spite of that, the ratios are all reviewed. To maintain the gross stage 3 or gross NPA ratios at that level, and post that, the profitability that the company has demonstrated, consistently between 2022 till now, is something which we would expect the investors to look at, and specifically addressing your question, because this is the kind of return, the kind of profitability that very few have been able to demonstrate in this particular sector. That would be the reason why investors would and are possibly interested.
Just a follow-up question. So how would you mitigate this asset quality risk in the future? You said that it's top of the mind of the board. Can you just elaborate on that?
No, so it's not in the future. It has been consistent. It is continuing. It is rigorous focus on three things: underwriting, monitoring, and collection. And as the company has grown significantly over the last 3 years, this aspect not only has not been diluted, it has been strengthened. So that gives us the confidence that whatever has worked so far, we will continue to further strengthen that, so that we make sure that as we grow, so the growth has been significant. It was 60,000 crore of AUM a few years back. It is now 1 lakh plus AUM, 1 lakh plus AUM. This significant growth has been accompanied by a significant improvement in the gross stage 3 ratios post, which was there at the time of COVID, and what we have managed to bring now. And the focus of the management will continue to be on doing everything possible to ensure quality, to ensure growth with quality. And that is the key differentiator which I think, which sets and would set HDB apart from many of the other finance companies which may be operating in the market.
Thank you so much.
Thank you.